All right, well, Jahangir Aziz is with us, Global Head of Emerging Market Economics at JPMorgan. Jahangir, great to have you with us here on the program. It's been a while, so good to see you here. So what's the sort of latest setup and how are expectations moving, given that data perhaps in the US is coming in stronger, but the people who make policy are sounding dovish, starting with Chair Powell. So will the markets believe what they're saying or what the data shows us?
Look, the data has been doing broadly what the global narrative has been from the beginning of the year, that growth is going to hold up reasonably well. I'm talking about the US economy. I think the surprise bit has been that the growth is holding up much better than we thought. And at the same time, you have seen, the impact of the rate hikes getting muted by the fact that the financial conditions in the US, and I'm not talking about the last month or so, but financial conditions in the US, let's say compared to where we were in September last year, has eased quite a bit, so that the fear that there is still lingering a dampening effect from the rate hikes on the economy, that I think is fading away. And at the same time, you've had very strong immigration flows, and you have had very strong productivity growth, which has kept profitability quite high and has delivered very strong employment numbers without actually leading to higher wages or creating spikes and reducing unemployment too sharply. So I think you are going to see a growth actually deliver upside surprises. It has already surprised us probably for 4 or 5 straight quarters. It's probably going to continue to surprise us on the upside. You've seen the ISM numbers. They are now manufacturing joining the service sector recovery that has been going on for quite some time. I think the concern obviously is inflation. And I think the concern isn't so much that inflation is going to spike back up. Core PC has been reasonably well behaved. It's just that last mile problem where can US get inflation down to that 2% core PCE number and sustain it there? I think that's where the market is concerned with. But as far as the policymakers are concerned, you should listen to Chair Powell or you listen to the officials around the Fed. Chair Powell's view has been guiding us, I think, to a June rate cut. That's what we have. Probably about 3, maybe a little bit more, but 3 is what we have in our baseline. The officials around Chair Powell are guiding to higher for longer. No one really knows what higher for longer means. Does it mean staying where you are for a longer period of time, or does it mean another 3, 4 rate cuts, and that too would be construed as higher for longer? So I would say that you tend to listen to Chair Powell more than the people around Chair Powell, and I think we're still on track for a June rate cut with about 3 rate cuts this year.
Okay, June rate cut from the US Fed and 3 rate cuts this year. Got that. What about the RBI, Jahangir? On Friday, we have the first meeting of FY25. I mean, no one's expecting any move on rates, but do you think the stance could change this time? Are we headed for a surprise?
No, I don't think so. I think, look, look, if you're going to buy into an 8.5% growth rate, what change of stance should you expect? First of all, you still have pretty sticky, not core inflation, but you have pretty sticky headline inflation. We expect headline inflation to go down to near the a corridor over time. I think if you have a June rate cut, the earliest, given the very narrow differential with the US, I think the earliest you would see is probably a July rate cut, but it's going to be a very shallow rate cut. You can't have both 8.5% buy into an 8.5% growth rate and then say I want to have deep rate cuts.
Hi, Jahangir. Good morning and good to see you. And I wanted to ask you about the Chinese economy. It's posing a couple of problems, not just from an equity market standpoint that maybe they take some bit of the flows. The problem is that, with the Chinese economy rebounds, it gives inflationary concerns yet again. How do you see this panning out? Because you're seeing commodity prices again perk up.
So I don't think that, the linkages between Chinese growth or Chinese M2 growth or Chinese TSF growth, what used to be the thing that we used to look at and then say, well, commodity prices are going to do this, hasn't really panned out since the pandemic. Look at 2022, look at 2023, when 2022, growth seriously disappointed in China when China was still under COVID lockdowns. In 23, growth did pick up in the first quarter, but still disappointed given what the market consensus was. And then you look at import numbers of Chinese commodities. They didn't move an inch either in 2022 or in 2023. So I think that one needs to divorce oneself away from this idea that we have been used to, that Chinese growth, whether it's driven by infrastructure or real estate, is necessarily is linked to Chinese demand for commodities. China has been stockpiling commodities as separate from its growth needs, and I think we expect that to continue. So I don't really think that changes in Chinese growth, a rebound in Chinese growth, or a collapse in Chinese growth is going to matter for commodities. What will matter for commodities is that Chinese stockpiling strategy is going to put a floor to prices and most likely put a ceiling to prices, because when prices fall below a certain floor, they will come in to buy it. When prices move beyond a certain ceiling, they're going to get out of the market. So I think they're going to keep this movement in commodity prices range bound, but has little to do with the volatility or changes in Chinese growth. It hasn't happened for the last 2 years. I don't think in 2024 we'll see any change in their stockpiling strategy.
Jahangir, yesterday there was an article in, I think it was Bloomberg. It basically said, and I quote, investors are unwinding the buy India, sell China trade. Unwinding that trade. And it kind of had quotes from some large asset managers around the world. Are you picking that up? Is some of that going to happen? What's your sense?
I did not pick on the first part of the strategy, which was short China, long India in the first place.
No, not short. Sell China. I mean, that's happened, right?
The first part of the last 2 years was short China, long India. Now you're saying that people are moving to the other side. I do not buy into the first part, so I'm not buying into the second part. Look, there is an issue with emerging markets, and the issue is that emerging markets, if you leave aside fixed assets, so if you leave aside sovereign debt, if you look at the rest of emerging markets, in the equity space particularly, there is a sheer shortage of risky assets. China was the only one that had these $1 trillion market cap companies. You take China out of this mix, then in the rest of emerging markets, you do not have places where you could put in reasonable amount of large capital inflows, i.e. that the absorptive capacity of emerging market equity markets has been very, very shallow. If you think about market cap in India, market cap in India is what, about $4 trillion US? You have a company in US called NVIDIA whose market cap is $3.5 trillion. So I think size matters in these things. I think emerging market equity markets have a problem of absorbing large amounts of capital. You put in $10 billion in a market like India over a month, and suddenly everybody's screaming over valuation, and therefore the trade gets stopped up. I think that's what's happening in this world, in this shift towards, bottom. I don't know how you describe it, but you're winding down that trade. I think it's simply that China had good equity capacity. The other emerging markets don't have the equity markets do not have the capacity. You can't put in more than a certain amount of finite money in non-China emerging market equity markets. We have done that. Now we are looking at concerns of overvaluation. China clearly is undervalued, and that's why people are making that argument. But as I said, I never bought the first part of the argument. I'm not buying the second part of the argument.
All right, Jahangir, we'll leave it at that. Thanks a lot for joining in and speaking to us about what to expect from the US Fed and the Reserve Bank later in the weekend month.